So, you want to own a funeral home. It's often pitched as one of the most recession-proof businesses in America. Demand never disappears. Competition is limited by licensing, and a large share of revenue can be locked in years or decades before the customer ever needs the service, through what the industry calls pre-need contracts. That pitch is broadly true. What it leaves out is that this is one of the most heavily regulated small business categories in the country, governed by a federal rule written specifically because the industry spent decades exploiting the worst moment in a customer's life. And that regulatory structure, not the death rate, is what actually determines whether a specific funeral home is a good investment. The build and the industry's basic economics. Total startup costs for a new, ground-up funeral home run $750,000 to $2.5 million, dominated by property acquisition, $250,000 to $1 million or more, depending on market. Embalming and preparation equipment, $50,000 to $200,000, and initial merchandise inventory, caskets, urns, and outer burial containers, $30,000 to $100,000. Most new entrants instead acquire an existing licensed home because licensing itself is a meaningful barrier. Funeral director and embalmer licensure requires an accredited mortuary science degree and a supervised apprenticeship in nearly every state. And acquisition multiples for established, cash-flowing funeral homes typically run 6 to 8 times EBITDA, higher than most small service businesses, reflecting exactly how defensible the licensing barrier and the local reputation actually are.
Revenue per case varies by disposition type more than almost any other variable in the business. A traditional burial with viewing, ceremony, casket, vault, and cemetery fees generates $5,000 to $12,000 per case. A cremation, particularly a direct cremation with no viewing or ceremony, generates $1,000 to $5,000. Gross margins follow the same split. Merchandise, caskets, urns, vaults runs 40 to 50%, sometimes exceeding 50% on premium caskets specifically. Service margins run 45 to 65% on burials and 30 to 50% on cremations. After allocating labor, facility cost, and overhead properly, realistic net profit margin across the business lands at 10 to 20%, meaningfully lower than the gross margin headlines the industry sometimes quotes because those headline figures routinely exclude labor and transportation. Mechanism 1, the only federal law of its kind and why it exists. The FTC Funeral Rule, formerly the Funeral Industry Practices Rule, took effect April 30, 1984, and remains the only federal regulation in the United States mandating itemized pricing disclosure in any retail industry. Its origin is specific. Investigative journalist Jessica Mitford's 1963 book, The American Way of Death, documented systematic upselling of grieving families, package deals that couldn't be unbundled, caskets shown only after a family had already committed emotionally to a full-service funeral, and pricing tied to what a family's life insurance payout could bear rather than to the actual cost of goods and services. The rule's core mechanism is the general price list. Any funeral provider must furnish, to any person who asks, in person, free of charge, an itemized list covering all 16 specific categories of goods and services offered before any discussion of arrangements proceeds. A provider cannot condition the sale of one item on the purchase of a package.
A consumer has the explicit legal right to purchase only what they want, a casket from a third-party retailer instead of the funeral home's own inventory, a basic service fee without embalming, cremation without a casket at all, since no state requires a casket for cremation. Violations carry civil penalties that can reach tens of thousands of dollars per violation, enforced by the FTC directly, rather than through private consumer lawsuits, which is precisely why compliance sweeps, rather than litigation, are the industry's actual enforcement mechanism. The rule was reviewed and reaffirmed in October 2022, and a further amendment requiring online price posting remains under consideration but has not yet been adopted, meaning the fundamental transparency mechanism, a physical, itemized price list, is 40 years old and still the law's central tool in a market where most consumers still shop for this specific product exactly once in their life, without the repeat purchase experience that disciplines pricing in almost every other retail category. Mechanism 2, pre-need contracts, are the industry's actual working capital engine, and state trust law decides how much of it the funeral home ever sees. A pre-need contract lets a person pay in advance, in a lump sum or in installments, for their own future funeral, locking in today's pricing against future inflation and relieving survivors of both the cost and the decision-making burden at the worst possible moment. From the funeral home's perspective, pre-need is the single most valuable thing this business can sell because it converts a one-time, unpredictable transaction into contracted future revenue with a known cost basis. But state law, not the funeral home, decides where that money actually goes.
Nearly every state requires a substantial percentage of pre-need payments, commonly 70 to 100%, depending on the state and the specific goods versus services split, to be deposited into a regulated trust account or converted into a life insurance or annuity product, rather than sitting in the funeral home's operating account. The trust's principal is legally protected. Only the interest or investment growth is meant to fund any future price increases between the date of sale and the date of death. This structure exists specifically because, absent it, a funeral home could spend pre-need deposits on today's operating expenses and simply hope enough new pre-need sales arrive each year to cover the previous cohort's eventual claims, structurally identical to a Ponzi scheme, funded entirely by the fact that nobody finds out the money is missing until decades later, at the exact moment a grieving family shows up expecting a funeral that was already paid for. Mechanism 3. Perpetual care trusts apply the identical logic to the ground itself, indefinitely. Cemeteries face a parallel and, if anything, harder obligation, maintaining the physical grounds forever, long after every plot has been sold and no new revenue is coming in. State law typically requires 10 to 30% of every plot sale to be deposited into an irrevocable perpetual care trust, sometimes called an endowment care fund, with the principal legally untouchable and only the investment income available for mowing, road maintenance, and general upkeep. This works cleanly while a cemetery is actively selling new plots, since fresh principal keeps arriving and cross-subsidizes maintenance in the interim. It becomes structurally fragile at older, fully sold-out cemeteries, where no new deposits are coming in, and the fund has to sustain grounds maintenance purely on investment returns for decades or centuries. Industry data indicates close to 40% of cemeteries with perpetual care funds have had to supplement maintenance from general operating revenue because trust income alone wasn't sufficient. And in the worst cases, operators have drawn down principal in violation of the entire legal structure, which is exactly the failure mode the trust requirement was designed to prevent in the first place. Mechanism 4. Cremation has inverted the industry's core unit economics, and most operators are still repricing around it. Cremation surpassed traditional burial nationally within the past decade and is now running at roughly 55 to 63% of all dispositions, projected by the National Funeral Directors Association to reach approximately 82% by 2045. This is not a preference shift the industry can simply absorb because burial and cremation are structurally different unit economics, not the same product at a different price. A traditional burial requires a casket, embalming, a vault or grave liner in most cemeteries, a cemetery plot itself, and typically the most staff hours per case, generating both the highest revenue and the widest merchandise margin because of casket and vault attachment. A cremation eliminates most of those line items entirely. A direct cremation needs no casket, no embalming, no plot, and dramatically fewer staff hours, which means the operator loses not just revenue per case, but specifically the highest margin revenue category, merchandise, that made the traditional model work. The industry's documented response is repricing around service value rather than merchandise markup, packaging memorial services, staffed viewings, and premium urns into cremation offerings specifically to rebuild the average ticket, since a bare direct cremation at $1,000 to $2,500 carries a thin 15 to 25% margin, while a full-service cremation package with a memorial event can reach $3,500 to $5,000 at a materially healthier margin. Forms modeling this transition explicitly track pre-need enrollment as the actual hedge against the shift, because locking in a family's choice and their trust fund principle years before the cremation versus burial decision plays out protects revenue against a mix shift the operator otherwise can't control. Mechanism 5. The industry's dominant firm grew by buying family-owned funeral homes and deliberately keeping the name on the sign. Roughly 89% of America's approximately 19,000 funeral homes remain independently, often family-owned.
The remaining share has consolidated, led overwhelmingly by Service Corporation International, the Houston-based public company that operates under multiple brands, Dignity Memorial among them, across more than 1,900 funeral homes and 490-plus cemeteries in 44 states and 8 Canadian provinces, serving roughly 600,000 families a year and added 121 acquisitions in a single recent year alone. What separates SCI's strategy from consolidation in almost every other industry in this series is the branding decision. When SCI acquires an independent funeral home, it almost always keeps the original family name on the building, keeps the local staff, and gives no external signal that ownership has changed. One documented case involved a Texas family whose parents purchased cemetery plots in 1960 at a business that had operated under the same family name since 1898. SCI acquired the cemetery in 1998, changed nothing visible, and the family didn't learn ownership had changed until they arrived to bury a family member 2 years later. Multiple independent pricing surveys, including work by the Funeral Consumers Alliance, have found corporate-owned locations operating under a retained family name typically charge 20 to 50% more than genuinely independent providers for comparable services in the same market. The mechanism isn't deceptive in the legal sense. Disclosure obligations under the funeral rule are about itemized pricing, not corporate ownership structure. But it means the single biggest signal most consumers use to select a funeral home, this is a trusted local family business, is frequently no longer true by the time a family is standing in the arrangement room making decisions under emotional and time pressure, which is precisely the environment in which price sensitivity is lowest and premium pricing sticks hardest.
Where the model breaks at a scale that dwarfs almost every other case study in this series. National Prearranged Services, based in Missouri, sold pre-need funeral contracts to nearly 100,000 customers across 16 states over more than 2 decades. State law required customer funds to be placed with a third party, a bank-held trust or a life insurance policy, and invested only in safe, approved instruments. Federal investigators found the company did essentially the opposite. Application documents were altered to change deposit amounts. The company named itself as beneficiary on life insurance policies meant to protect customers. Whole life policies were converted to term policies to free up cash, and money already sitting in trusts and insurance policies was in some cases physically removed after the fact. The company also bought blocks of existing pre-need contracts from other funeral homes, telling those homes the obligations would be rolled into insurance policies, while quietly reusing the same customer money to pay current claims instead. The textbook mechanics of a Ponzi structure, sustained specifically because pre-need's entire premise is that the money isn't needed again for years or decades. The FBI ultimately characterized the scheme as having taken roughly $500 million from customers. One victim, who paid in full in 1999 and was told her funeral was covered and her trust funds would grow, received a letter 26 years later informing her the contract was void, along with a check for $599.11 against a funeral that by then cost roughly $6,000. This is not an isolated failure. Smaller-scale versions of the identical pattern, trust accounts holding a fraction of their required balance, have surfaced repeatedly at the state level, from Mississippi funeral homes found holding $221 in a trust account that should have held $373,591, to a Prince Edward Island funeral home whose owner faced 66 fraud charges after prepaid funeral money for dozens of families simply vanished. The mechanism is identical every time. A business model that legally depends on money sitting untouched for decades is only as sound as the weakest link in a chain of trustees, regulators, and audits that most customers never think to verify, because the entire product exists specifically so they never have to think about it again.
Mechanism 6. The sales incentive structure sits closer to insurance than to retail, and that shapes the pitch. Pre-need sales are frequently handled by licensed insurance agents working on commission, not neutral funeral directors, because in most states, the underlying funding vehicle is a whole life insurance policy or annuity assigned to the funeral home, rather than a pure cash trust. This matters because the incentive at the point of sale isn't simply sell a funeral, it's sell an insurance-funded contract, which tends to favor higher face values and add-on riders the same way any commissioned insurance sale does. The sales conversation itself is also structured around a well-documented psychological anchor. Pre-need is pitched explicitly as protecting your family from having to make these decisions while grieving, which reframes a purchase decision most people would otherwise price shop as an act of care for people who aren't in the room yet. That framing is not dishonest. prepayment genuinely does spare a family real burden, but it also means the entire sales process is optimized to short-circuit the same comparison shopping instinct the funeral rule was written to protect, because the decision is being made years before the emotional urgency of an actual death, by a person selling on behalf of the same company that will eventually deliver the service, with no competing quote in the room. Two ways to actually get exposure to this industry, and they carry very different risk. Direct ownership, buying or building a licensed funeral home, means carrying real regulatory risk. Trust compliance audits, state licensing renewal, and personal or corporate liability if a pre-need trust is ever found deficient, on top of the standard.
Operating risk of any small business. There's also a second path. Service Corporation International trades publicly on the New York Stock Exchange, giving any investor fractional, liquid exposure to the same underlying economics, pre-need contract origination, perpetual care trust management, and the pricing power that comes from scale and brand consolidation, without ever personally signing a trust compliance filing. The trade-off mirrors what shows up across this entire series. Direct ownership captures the full margin and the full deal-specific risk of a single location's trust compliance and case mix, while the public company captures a diversified, professionally managed, but structurally more modest return, because SCI's own scale invites exactly the kind of regulatory and reputational scrutiny and occasional litigation over pricing practices that a single independent operator with a genuinely good local reputation may never encounter at all. 4 numbers to check before buying or investing in any specific funeral home. First, the pre-need trust funding ratio against its legal minimum, not against the funeral home's own internal accounting. The Mississippi and Prince Edward Island cases both looked financially sound on the funeral home's own books until a state regulator or a family's claim forced an independent count. A buyer should request and independently verify with the trustee institution directly the actual funded balance against every outstanding pre-need obligation, not a number the seller self-reports. Second, disposition mix trend over the past 5 years, not the current year in isolation.
A funeral home still pricing and staffing as though it's an 80% burial operation, while its actual mix has quietly crossed 60% cremation, is running a cost structure built for a business it no longer has. Third, whether the location is independently branded or operating under a retained name after a prior corporate acquisition. This affects both the achievable price point — corporate-owned locations can often sustain higher prices — and the reputational risk if that ownership history becomes locally known, since the Washington Monthly and regional reporting on this exact pattern has made "Is my local funeral home secretly corporate-owned?" an increasingly searched question among exactly the demographic old enough to be planning pre-need arrangements. Fourth, perpetual care funding status for any attached cemetery, specifically whether the cemetery is still actively selling new plots or is functionally sold out and dependent purely on trust investment income. A sold-out cemetery with a thin, underfunded perpetual care trust is a long-tail maintenance liability that doesn't show up on a standard year-one profit and loss statement at all. The emerging line item most operators haven't priced yet: green burial and alkaline hydrolysis. A newer disposition category is growing from a small base, but carries genuinely different unit economics than either traditional burial or flame cremation. Green burial eliminates embalming chemicals, metal caskets, and concrete vaults in favor of biodegradable containers, cutting merchandise cost by as much as half compared to a traditional burial. But it also strips out the highest margin product categories, the same structural problem cremation created, just via a different mechanism.
Alkaline hydrolysis, sometimes marketed as water cremation, is now legal in a growing number of states and requires specialized equipment costing $100,000 to $150,000 per unit, a real capital commitment for a disposition method that, as of today, still represents a small, single-digit share of total cases nationally. The operators moving early on alkaline hydrolysis are making the same development spread bet that shows up in real estate: absorb the equipment cost and regulatory approval process now, while few competitors have done so locally, in exchange for being the only provider in a market when demand for the option matures, rather than the 10th provider once the equipment cost has become a competitive necessity instead of a differentiation. Seasonality is real here too, just driven by mortality rather than moving trucks or wedding calendars.
Death rates in most U.S. regions run meaningfully higher in winter months, driven by respiratory illness, cardiovascular events triggered by cold exposure, and holiday-adjacent health crises, with a secondary smaller spike during summer heat events in warmer climates. This creates a genuine capacity planning problem distinct from every other business in this series. A funeral home can't build inventory ahead of a predictable seasonal surge the way a retailer stocks up before a holiday, because the product is delivered on a fixed short timeline dictated by state law on body disposition, typically requiring burial or cremation within a matter of days, absent specific embalming or refrigeration arrangements. A home staffed for its average monthly case count will be structurally understaffed during a winter surge and overstaffed the rest of the year. And unlike a seasonal retail business, there's no way to simply turn away excess demand in December. State licensing and basic public health obligations mean a licensed home has to absorb whatever volume the season sends.
On a service's timeline, the business itself doesn't fully control. The regulatory apparatus that surrounds this industry, the funeral rule, state trust statutes, perpetual care law, licensing boards, exists almost entirely because the product itself resists the normal market discipline of comparison shopping and repeat business. A customer who gets a bad deal at a restaurant simply doesn't return and tells other people. A customer who gets a bad deal on pre-need arrangements often doesn't find out until decades later through a survivor, at a moment when renegotiating or shopping around is no longer realistically possible. Every mechanism covered here, itemized pricing, trust segregation, perpetual care principal protection, exists specifically to substitute for the comparison shopping that can't happen naturally, and the businesses that treat those mechanisms as the actual product, not paperwork sitting between them and a sale, are the ones whose acquisition multiple and reputation actually hold up over a multi-decade horizon. The break-even, plainly, across the disposition mix that actually matters. Fixed operating expenses for a funeral home commonly run $215,000 to $675,000 annually, covering facility, licensed staff, vehicles, and insurance. On a mid-market operation with $450,000 in fixed costs, a case mix of 55% cremation at an average $2,800 net margin per case,
and 45% burial at an average $4,000 net margin per case, blended toward roughly $3,340 in contribution margin per case, the home needs approximately 135 cases a year just to clear fixed costs before pre-need trust income, merchandise attachment, or ancillary services move the number in either direction. The number that actually predicts long-run health isn't case volume in a given year, since death rates are demographically stable and close to guaranteed locally. It's the percentage of that volume converting to cremation versus burial, since a home's entire margin structure was originally built around burial-era merchandise attachment that a cremation majority future simply doesn't generate the same way. A funeral home with a full parking lot on a given week and a trust department that's never been independently audited can look identical to one that's fully solvent, right up until a family arrives expecting a service that was, on paper, already paid for.